This is the Do-It-Yourself Guide to Business Buying. Today we're talking about finalizing financing. Welcome, business buyers. What is our goal with this video, Finalize Finance? I want to discuss how lenders and investors process funding requests. It's sometimes confusing. So you need acquisition funding. You have one option, which is to raise some debt, and you have a second option, which is to raise some equity. Let's start by taking a look at debt. Acquisition debt comes in many forms. We can borrow against receivables, against fixed assets. If there's a property involved, we can potentially mortgage it, maybe a cash flow loan or types of loan, line of credit, term loan. There are SBA loans out there. Maybe we're going to issue a convertible loan and other alternative loans. But here's the issue. It can be confusing, and here's why. Because lenders who loan money as a business have two groups in their business. One you interact with, the other one you don't. What are these two groups? One of them is customer facing. The other one is internal facing. I'm going to call the customer facing group the loan originators. You hear that term being used. They work on the business development side of the bank or financial institution. Their goal is to write business. It's to generate business for the lender. And these are the people that you interact with. But there is a second group that's more internal facing. These are the underwriters. This is the credit committee. Their goal is to manage risk on behalf of the lender. They are the ones that approve your loan, but you're not going to have any interaction with them. We only deal with the loan originator side, the customer-facing side. So customer-facing loan originators, they collect the information, they process applications, but it's the internal people, the underwriters, the credit committee, that make the lending decision. Loan originators. Now, they go by different titles: loan officer, account executive, lending specialist, branch manager, financial advisor. There are other names as well. They have four main responsibilities. Number one, they are your primary contact as a borrower. They're going to guide you through the loan application. They're going to lay out and explain different options to you as a borrower, and they're going to collect all the necessary documents from you as a borrower, and they can indicate interest in your deal two ways. Number one, an expression of interest, sometimes called an indication of interest. We went into these in detail in a previous video. And of course, the term sheet, sometimes called letter of intent. I don't like to use letter of intent in this context, because we're reserving letter of intent for what a potential buyer sends to a seller. But the expression of interest, it's an initial document. It's often very informal. It indicates the lender's willingness to explore an opportunity of potentially making a loan. It'll include loan amounts, high-level terms. Very little due diligence has been done at this point. Now, the expression of interest or the indication of interest is optional. Sometimes it's just done verbally. So some lenders will issue an expression of interest, some won't. But in terms of the term sheet, yes, everyone's going to give you a term sheet. It serves as a proposal from the lender, and it's very detailed in terms of terms and conditions. It does include proposed loan covenants, and some cursory due diligence will have already been done for the term sheet as well. The lender is interested in proceeding, and the term sheet will also include an expiration date. Let's take a look at arranging acquisition debt. We find a lender, we close the loan. This looks very similar to other slides we've looked at where it was find a deal, close a deal. Now we're talking about find a lender, close a loan. We've got the expression of interest. We've got the term sheet. And as we said, both of those come from a loan originator. And of course, they're not legally binding. So that's that part of it taken care of. Now let's take a look at internal facing, the underwriters and credit committee, and see how that works. Credit committee, we have no interaction with underwriters. They are internal risk managers. They are the final decision makers, however, on approving any loan. And so that's the kind of hidden ingredient here, is that the decision makers are not people that you're actually dealing with and talking to. Of course, the loan originators have connection to the credit committee. It's not like they're completely separate entities, but at the end of the day, you're not talking to the final decision maker. So how do underwriters engage with the borrowers? Not through a direct interaction, but they are responsible for the commitment letter. I'm sure they work with originators on that, but ultimately it's their call when a commitment letter goes out, and of course the loan agreement as well. The commitment letter happens after substantial due diligence is completed. It includes the final loan terms, but it's still subject to closing conditions being met. So in a way it's legally binding, but it's also subject to closing conditions being met. Include things like a material adverse change clause. If things change between the commitment letter and the loan agreement, right, we're not going to necessarily close, so final checks are still pending. And I would say legally binding, subject to closing conditions. Let me show you more closely what I mean there. If we get a commitment letter there's a time lag between getting that commitment letter and the loan agreement being signed. And that is why we need closing conditions that have to be maintained. That's why we have a no material change clause. It's because of that time lag. Lender's saying, yeah, we're ready to go. Here's a legally binding commitment. However, it's only binding as of how things look today. If things change in the future, we are not going to close. And so that's what we mean by closing conditions. So the loan agreement, of course, is handled by the legal team of the lender, not with the credit committee or the underwriters themselves, but they are, of course, involved. It has the final terms and conditions. It's fully legally binding. It represents the loan closing. It includes a security agreement if we're pledging assets, and the funds are released to an escrow account as part of the acquisition. So we have the commitment letter, which moves to the loan agreement. So this puts it in nice context. The first two, the expression of interest and the term sheet, come from the loan originator. The commitment letter and the loan agreement, however, are under the direction of the underwriters who have the final say. So keep that in mind. When does a loan close? A loan closes when the loan agreement is signed. Now, what about lenders who say that a loan is pre-approved for a business? I get this question all the time. How should you interpret that? Is that a statement that's coming from the loan originator, or is it coming from the underwriting team? Let me make that clear. It's coming from the loan originator, not from the underwriting team. A pre-approved loan is the equivalent of what? Of an expression of interest, a term sheet, a commitment letter, a loan agreement? I come across so many new business buyers who think that a pre-approved loan is the equivalent of a commitment letter. Is that true? No, it's really not. In reality, it's much closer to just a simple expression of interest, or at best, part of the way towards a term sheet. The takeaway is that pre-approvals don't come from the underwriting team. And yes, it indicates lender interest, but only at the level of an expression of interest. Now, with an individual rather than with an institution, the loan originator and the credit committee could be the very same person, right? But they still tend to wear different hats. Loan origination and underwriting are two different tasks, and even if someone is lending on their own account, they typically look at those things differently, so keep that in mind. So that's debt when we're looking at acquisition funding. Let's take a look at equity. We'll do that next. When we're raising equity, do equity investors also have two groups? One market-facing, deal flow originators? The answer is yes. And deal flow originators are sourcing opportunities. And these are the people that are interacting with investee-type companies, collecting information from them, etc. And they do have an internal-facing part of their business, which is best described as an investment committee, and it handles the risk-return for the investor group. And they are ultimately the ones making the investing decision. It's not as clear-cut as it is when you're talking about lending, but there are some similarities. There are some parallels. I mean, they aren't the same concept, but I would say similar. I'd say there probably aren't two groups, but there are people who have two different roles. They have an originator role where they are trying to find opportunities. They are focused on deal flow. But of course, once we're in a situation where we're talking about writing a check and making an investment decision, the investment committee looks at things a little bit differently. Now, when we're raising equity, there are some issues related to securities law that I do want to mention. Let's say you and your partner, Max, you're 50-50, you want to buy a business. So you incorporate an SPV, a special purpose vehicle. Of course, it's going to be governed by corporate law and whatever shareholder agreement or operating agreement you have in place. Unlikely in this kind of a scenario to have securities law issues if you and Max are founders who launch an SPV to buy a business. So you've got your SPV, you buy a target co. If done properly, not going to be a lot of issues in this case when it comes to securities law. But let's say it's a slightly different scenario. You need to bring Sue in as an investor. Sue's got money, and for $500,000, Sue will own 50% of your company, and you're going to use that $500,000 as part of your acquisition funding. Now, there are two ways to bring Sue into the business. You and Max could sell 50% of your shares to Sue and then invest the money that they give you in the SPV. Number two, the SPV could just issue new shares to Sue for $500,000, which seems a little bit more straightforward. But they aren't the same. They do trigger different issues, and I want to make you aware of them. If Sue has issued shares of the SPV, you have to address, number one, registration and exemption. When you offer shares for sale, if you solicit investors, you have registration requirements unless you qualify for an exemption. So you do have to go down that road. Number two, In the situation where you're issuing shares, typically you have to have a disclosure document that discloses all material facts, like a private placement memorandum, a PPM, or something like it. Sometimes we're limited to only having accredited investors invest in the business, so there's that limitation as well. You need your eyes wide open whenever you're in a situation where you're issuing shares, because securities law definitely has a lot to say about it. Now, if Sue has sold existing shares, we have issues to address, but they're a little bit different. And now all of a sudden it's an insider transaction, so their rules apply, to insider type trading, because you're an insider, you're selling shares to a non-insider, and so you have some rules that have to be followed. And if you do it all the time, you could be deemed to be a potential broker dealer of securities. If you only do it once, it's much less of an issue. You have to be on side with the shareholder agreement or the operating agreement, etc. So you do have rules on both sides, but when you're issuing shares, I think they're a lot more stiff. Of course, in both cases, you also need to deal with the operating agreement if it's an LLC or the shareholder agreement if it's a C Corp. So it's pretty important to use legal counsel that has relevant experience. You need to understand the steps associated with finalizing the financing if you want to operate with confidence. Now, it would have been nice to go through some examples, but there's so many different examples of debt and equity and different scenarios and different groups that provide money in those two scenarios. So it's really hard to generalize, but hopefully we've given you some tips and some things to think about when you're finalizing the financing. In the next video, we're going to talk about the buy-sell agreement. Let's get after it. This is the Do-It-Yourself Guide to Business Buying, and today we're talking about finalizing the financing because we want to learn and grow as we go. Thanks so much for watching. We'll see you next time.